September 2019. Jeffrey Epstein is dead. He died in a New York federal detention center in August 2019, officially a suicide, while awaiting trial on sex trafficking charges. And now, a month after his death, JPMorgan Chase files a special document with the U.S. Treasury Department, a suspicious activity report. It details more than 5,000 transactions. The total amount is $1.3 billion. The bank reports, it's all suspicious and connected to Epstein. Wait, $1.3 billion in suspicious transactions from one person's accounts. The bank filed this report in September 2019. JPMorgan filed its first suspicious activity report on Epstein's accounts in 2002, 17 years ago. Over the course of 17 years, while Epstein lived, paid victims through this bank's accounts, recruited women, flew on his own jet, and hosted the world's richest and most powerful people in his mansions, JPMorgan reported suspicious transactions totaling $4.3 million. Not a billion, a million. 4.3 million in life, 1.3 billion after death, a 300-fold difference. This is the number Senator Wyden will use at the center of his investigation into the bank's activities, because this number explains everything. This isn't a story about Jeffrey Epstein. His story ended in that cell. This is a story about banks, about people in expensive suits who read internal reports, received warnings from their own security analysts, and were told, keep going. 1998, JPMorgan Chase opens an account for a new client, Jeffrey Edward Epstein, born in the 1950s, financier, officially manages the money of wealthy clients. In reality, no one really understands where he gets so much money. The source of his wealth has always been murky. He calls himself a family fortune manager, but publicly says he works only with clients worth over $1 billion. His client list is classified. His biographical information is contradictory, but he is rich, very rich, and he has connections, rare connections. Prince Andrew of the UK, former President Clinton, former President Trump, Harvard professors, tech billionaires, scientists, and Nobel laureates. For a bank that caters to ultra-wealthy clients, Epstein is more than just a client. He's a source of new clients. He can introduce bankers to people who would otherwise be inaccessible. One specific example, Leon Black, the founder of Apollo Global Management and one of the most influential wealth managers in the world. Black was a friend of Epstein's and personally paid him $158 million, ostensibly for tax advice. This was a direct commercial link between the world of the ultra-rich and Epstein, and it was precisely these kinds of people that Epstein brought to JPMorgan. The bank didn't want to lose access to this network. Epstein belongs to a special category of JPMorgan clients. The Senate investigation would later describe them as the Wall of Money, an elite group of clients with exceptional access and exceptional service. The main liaison between the bank and Epstein was top manager Jess Staley. He would later become the CEO of Barclays. At the time, he was one of the most influential people at JPMorgan. Staley and Epstein were more than just business partners. Staley personally flew to Epstein's island, personally visited his apartment, and personally exchanged more than 1,200 letters with him, including photographs of young women in seductive poses. In one letter, Staley wrote to Epstein, "Our friendship is profound." 2002. JPMorgan's compliance department files its first suspicious activity report on Epstein's accounts. The reason? The transactions appear to be from individuals, especially young women. The report is archived. The accounts continue to operate. 2006. Epstein is accused for the first time in Florida of sexually assaulting a minor. This isn't hush-hush information, it's public news. A JPMorgan employee writes in an internal email, "We need to do something about this client." The bank's risk management team simultaneously notes something specific in his transactions. Epstein regularly withdraws between $40,000 and $80,000 in cash several times a month. In 2006, he withdrew over $750,000 in cash from bank accounts. Banks are required to file reports on suspicious cash withdrawals of this magnitude. These reports are called currency transaction reports. But according to the Senate investigation, employees of the private banking department concealed information about Epstein's transactions from the compliance department, not out of ignorance, intentionally. Moreover, according to the Senate Finance Committee's investigation, former JPMorgan private banking CEO John Duffy personally advised Epstein on how to structure cash withdrawals to minimize reporting and how to execute transactions to lessen the scrutiny of regulators. The banker taught his client how to circumvent the oversight system that the bank itself was obligated to comply with. 2008. Epstein pleads guilty. Florida court. He is guilty of soliciting prostitution from a minor. The judge sentences him to 13 months in prison, a lenient sentence that will later become the subject of separate investigations. During his sentence, Epstein is allowed to leave prison 6 days a week, ostensibly to work. Following the verdict, JPMorgan is assessing the situation. Internal documents leaked during the trials reveal the following. Some employees insisted on closing the accounts. Their motivation was reputational risks. Other employees insisted on the opposite. Their motivation was the client's profitability and their value as a source of other wealthy clients. The latter argument prevailed. JPMorgan continues to serve Epstein. 5 years after he pleaded guilty to sexual assault against a minor from 2008 to 2013. During this period, according to the Senate investigation, payments to Ghislaine Maxwell were routed through his JPMorgan accounts. Maxwell was Epstein's girlfriend, later convicted of participating in his crimes and sentenced to 20 years in prison. According to the prosecution, she recruited young women for Epstein. The total amount of payments to Maxwell through JPMorgan accounts was at least $25 million. One transaction amounted to a one-time payment of $19 million. Besides Maxwell, regular payments to other individuals in his circle were processed through the same accounts. The case files indicate that the transactions matched the pattern of payments to trafficking victims, cash and wire transfers, in unusual amounts and at unusual intervals. It was this pattern that the bank's compliance department described as suspicious in its internal reports. The bank sees transactions in real time. The bank knows who Maxwell is. The bank doesn't stop payments. 2013. JPMorgan finally closes Epstein's accounts. The official explanation: standard customer due diligence. In reality, there was too much internal noise and too much risk. And here is where the story takes a turn. A few days after JPMorgan closed his accounts, Epstein opened accounts at Deutsche Bank. Deutsche Bank is one of the largest in the world, fourth largest by assets in Europe. They know exactly who Epstein is. In 2008, his name was in the global news. He's a convicted sex offender. This information is public, available to anyone with internet access. Deutsche Bank is conducting a compliance check on a new client. It's documented that the employees conducting the check knew about his past. They knew about his conviction. They knew about his status as a registered sex offender. The decision to accept him as a client was made at a level above the compliance department. Deutsche Bank takes him on as a client. Inside Deutsche Bank, the story is the same as at JPMorgan. Compliance officers are raising the alarm. The transactions look suspicious. The pattern of cash withdrawals resembles payments to trafficking victims. Warnings are passed on to management. Management says, keep going. According to New York State regulators, even after receiving warnings, the bank continued to expand its services for Epstein, adding mortgages and asset management. Deutsche Bank served Epstein from 2013 to 2018. In 2019, Epstein was arrested again. This time it was federal charges, the sex trafficking of minors. The scale and details exceeded anything publicly suspected. The investigation unfolded. The names of Epstein's acquaintances began to fill the headlines. In August 2019, he was found dead in his cell. The official version is suicide. The security cameras in the hallway failed that night. The guards were asleep. The suicide theory is officially accepted. His family and some members of the community doubt it. That's a separate story. And here comes a figure that does not allow us to close the bank's history. September 2019, 1 month after Epstein's death, JPMorgan files a suspicious activity report with the U.S. Treasury Department. It details over 5,000 transactions. The total is $1.3 billion. The period is October 2003 to July 2019. From 2002 to 2016, the bank filed 7 reports totaling $4.3 million in suspicious transactions. After Epstein's death, it filed 1 report totaling $1.3 billion, a nearly 300-fold difference. Senator Wyden, after studying these figures, said, JPMorgan, while Epstein was alive and actively committing crimes, reported approximately 1% of the true picture to regulators. The remaining 99% was revealed to authorities only after it could no longer stop any crime. 2020. The New York State Department of Financial Services fines Deutsche Bank $150 million for anti-money laundering violations in its dealings with Epstein. This is the bank's first financial penalty for its ties to Epstein. May 2023. Deutsche Bank agrees to pay $75 million to Epstein's victims. June 2023. JPMorgan Chase agrees to pay $290 million to victims, more than 100 women who suffered at the hands of Epstein while the bank serviced his accounts. September 2023, JPMorgan pays an additional $75 million to the government of the U.S. Virgin Islands, the territory where Epstein owned an island and where his companies were registered. JPMorgan's total settlement, $365 million. It's the largest settlement ever paid by a financial institution in a sex trafficking case. None of these settlements involve admissions of guilt. JPMorgan wrote in a statement, "We deeply regret any association with this individual and would never have continued our relationship with him if we believed he was using the bank in any way to commit his crimes." That's the official position. Now look at the facts. The bank filed a suspicious activity report on Epstein's accounts in 2002, 17 years before his arrest. The bank knew since 2006 that Epstein was accused of sex crimes. The bank knew since 2008 that he was convicted of child sex crimes. The bank was aware of large, systematic cash withdrawals that its own security analysts described as suspicious. A bank employee personally advised Epstein on how to reduce the visibility of these transactions to regulators. Ghislaine Maxwell's $25 million payments were routed through this bank. The bank only reports just over $4 million in suspicious transactions while Epstein is alive. It reports $1.3 billion immediately after his death. There's only one explanation for this difference. While Epstein was alive, the bank didn't want the authorities scrutinizing his accounts too closely. After his death, an investigation is inevitable, and it's better to report it yourself than to be caught off guard. Financial analysts call this behavior strategic compliance. It's not violating regulations out of ignorance, it's controlled violation, disclosing just enough to avoid technically violating the law and not disclosing enough to avoid losing a valuable client. Jamie Dimon, CEO of JPMorgan from 2005 to the present, says under oath that he never accessed Epstein's accounts. He led the bank for the entire 15 years Epstein was a client. He has never been criminally charged. He remains CEO of the largest bank in the United States. Jess Staley, a man who had a deep friendship with Epstein, visited his island and exchanged photos of young women, was forced to resign as CEO of Barclays in a separate scandal. No criminal charges were brought for his ties to Epstein. No banking executive has been convicted of a criminal offense for their role in creating the financial infrastructure of Epstein's network. In October 2025, Epstein's financial records, a vast trove of documents, were declassified. Among the data were more than 1,700 flights on his plane and over 140,000 documents, including correspondence with bank executives. Investigations are ongoing. Congress has requested additional materials from JPMorgan on specific transactions and the roles of specific executives. The bank's responses are still partially classified. The case is not formally closed. Here's what the JPMorgan and Epstein story tells us about how the world works. Epstein's crime required more than just money. He needed infrastructure, accounts for withdrawing cash and paying victims, transfers to international contacts, legitimacy. When you're a client of the world's largest bank, that in itself opens doors. The banks gave him this infrastructure, not out of ignorance, documented, out of a reluctance to lose a profitable client. The fines totaled $365 million. For JPMorgan, that's less than 1.5% of its annual net profit. This amount is classified as a settlement expense and written off before taxes. The system that allowed Epstein to operate for decades didn't collapse after his death. It's still in operation today. The same banks, the same managers, the same decision-making mechanisms, where the value of the client outweighs any red flags. The only thing that has changed is that it now costs a little more.